Hi everyone, I welcome you back to my channel Econopatsala. Today I'll be discussing about a very simple and powerful topic in macroeconomics. This is about circular flow of income. This is also the first model in macroeconomics which I'm introducing to you. First of all, what is a model? All of you are already exposed to a model in your early school, okay? And that is a globe. So globe is a model of Earth. Similarly, civil engineers, when they plan to construct a building, they first begin with preparing a small replica of the building. So that replica is a model of the real building. Okay. And engineers, when they're constructing roads, bridges, laying railway networks, they start with a layout map. That's a small model, okay, of the area on which the roads to be constructed or railways to be laid. Okay, so a model is basically a small replication or abstraction of a real world. In economics, we use models to capture the very complicated real life stories. So in an economy, you have different players. There are households who basically sell their labor services or their entrepreneurial ability, use their entrepreneurial ability, or lend their savings. Okay, so this way they earn different form of income. Say when a household is supplying labor, okay, so in exchange of work, what they earn is their wages and salaries. A saver earns interest income. An entrepreneur earns or profit, okay, by organizing production. So here there are millions of workers, there are millions of savers, and maybe thousands, lakhs of entrepreneurs. So each of their activity, understanding their mind, understanding their profit maximizing behavior, understanding their utility maximizing behavior is very complicated. Okay, so to simplify things, what economists do, they try to capture certain essential aspect of their behavior and key aspects of interdependence, interrelationship, and using that they simplify things, which helps us understanding the very complicated real world. So in that way, economic model is a simplification of real interactions, interlinkages in an economy, okay, which tries to capture the essence of all these relationships and understand how they interact, how they decide how much to consume, how they decide how much to produce, etc. So, as I said, these economic models, they capture the essential part which is critical to understand the behavior of a stakeholder or understand the interrelationship transaction among different stakeholders. And obviously, it will be ignoring many details. Like the globe. The globe doesn't have all the buildings, it doesn't have river, it doesn't have mountains, right? But if you want to understand how the earth is revolving around itself, and when it is coming towards the sun, the day begins. When it is going away from the sun, the night begins. So to understand how day and night occur repeatedly, using a globe is good enough to understand that. So to understand a particular aspect, we simplify the thing, and the economic model will be ignoring many other details which are not essential to a particular context. And these economic models, they assume, they restrict the behavior of the stakeholders, ignore certain things, and they only focus on the key variables which are relevant to the discussion, and focus on interaction among these critical key variables. I think as I discuss the circular flow of income, it will become more clear to you. In an economy, the activities of different stakeholders take basically three forms. These three are essential to understand broad economic activities in an economy and interrelationship among different stakeholders. First one, production. Production, it is basically combining various factor inputs to produce a particular level of output. Let us think of an automobile manufacturer. The automobile manufacturer has set up a factory. It hires engineers and workers, borrows fund from these savers, and using these different factors of production, which we call land, labor, capital, etc., and organization. So the automobile manufacturer, producer manufacturing cars. Similarly, farmer produces different farm products. Okay, so this is production of various goods and services by using various factor inputs. What is distribution here? The total output which is produced by a producer, okay, is distributed among different stakeholders. Part of the output, the value which or revenue which the producer obtains, part of that is given as wages and salaries to the workers. Part of that is given as interest payment to the savers who have provided fund. Part of that goes to the entrepreneur who basically contributed in terms of organizing the production. And part of that may be going as rent to the landowner or to the building owner, which is used for undertaking the production. So this way, total value of production goods and services which uh, you know came out of production is distributed among different stakeholders who contributed to the production of that amount of goods and services, and this distribution, income distribution, is in the form of, say, wages and salaries, profit, interest, and rent income. Okay, now all those stakeholders, basically the households who contributed for production and obtained their income, they use that income to purchase various goods and services. So ultimately, in economics, the households or the consumer is the utility maximizer. They are happy to consume various goods and services, whether it is purchase of groceries, purchase of fruits and vegetables, use of a car, use of air conditioned machine. Okay, so various goods and services which they consume, out of that they derive satisfaction or utility, and for purchasing those goods and services, the income which they obtain from production or by participating in the production process, they use that. Okay, so therefore production, distribution, and consumption are three critical economic activities which we popularly discussed in economics. So this is the picture, this economic model. Economic model is generally expressed in the form of equations or in the form of a graph. So the chart which have in front of you, this is the simplest version of circular flow of income, which we will use to understand the interaction between the business, that is the producers or firms on the one hand, and households on the other hand. So this is the simplest model. As I said, it is basically two sector model, we call it. So why it is two sector? Because we assume that these two stakeholders, the business or firms on the one hand and households on the other hand, they interact in two markets. Okay, I'm going to provide the details of that in the next slide. So in this circular flow of income model, it is a two sector model. We first assume what the households do. So we assume households are owners of various factors of production, like they own the capacity to work, they own savings, they own land and building, and they own the capacity which can be used for organizing production. So this way they wear the hat of a worker, the hat of a saver, the hat of an entrepreneur, and the hat of a landlord. Okay, now these different factor inputs which they own, they allow the producers to use these different factors of production, produce goods and services, and then, as I said, give them as reward different forms of factor income, like say wages and salaries, interest payments, rent, profit, etc. And these incomes, different forms of income, households use to buy various goods and services. Of course, partly they will save. Saving part I'll come later. In this simple model, I'm assuming that total income which they earn in different forms of factor income is totally adjusted to buy goods and services. Okay, to start with, this is a very restrictive assumption which I'll be relaxing later on but as of now, let us assume there is no savings. And what the producers do, our assumptions about the producer, they hire various factors of production, and using them, they undertake production of different goods and services, whether it is industrial good or a agricultural good or a service like aviation, like hair cutting. Okay, so producers are basically their legal entities. Okay, to simplify, let us talk about say Reliance Industries. So Reliance Industry is a registered company. It is a legal entity. Okay, and different factors of production which Reliance Industries hire are the engineers or workers which are working for them, the shareholders and owners of capital which provided fund to them. Say for example, Mukesh Ambani is the household here, and the Ambani household has they are basically providing their entrepreneurial ability to undertake production to Reliance Industries. So let us understand that way. So Reliance Industry is a legal entity. Tata Motors is a legal entity. Producers are these legal entities in our consideration, and the various shareholders like Tata Motors, for Tata Motors or for Reliance Industries, they are the households who are either provided fund or they are providing their entrepreneurial ability to undertake production. So these producers are using various factors of production, and they sell all these goods and services which they produce, and out of that they earn revenue. They try to maximize their revenue or maximize their profit. Okay, and these two sets of households, I mean two sets of players, households and farms or producers, they meet in two markets. One is product market and another is factor market. I'm explaining again in this graph here. So here on the upper part of the graph, okay, I'm assuming there is a factor market. So in the factor market, let us focus on the blue circles, blue color arrows, the upper part of it, which is moving from left to right. So households are selling their labor services, uh, funds, entrepreneurial liability, and allowing their lands and buildings to be used for the production process. So this way they are supplying different factor inputs on the upper part of the chart, okay, as shown in the blue color arrow running from left to right. And in exchange of these factor services, they are receiving factor payments from the producers or business, which is given in the black color line in the upper part of the chart running from right to left. So this interaction in the upper part of the chart is happening in the factor market. So in the factor market, to repeat, the households are selling various factor inputs to the producers. The producers are using these factor services, undertaking production, and in exchange of use of these factor services, they are making payments, okay, which is factor income in the form of wages and salaries, profit, interest, etc., etc. Similarly, the households and the producers, they are interacting in another market, which is the product market, and the interaction in the product market is shown in the lower part of this chart. So in the lower part of the chart, let us understand the producers are supplying various goods and services, cars, ice cream, aviation services, haircut, agricultural products. Okay, so these products is flowing from the producers to the households as shown in the blue color arrow in the lower part of the chart running from right to left. Okay, and to purchase these goods and services, the households are making payments to the producers, and these payments for purchase of various goods and services is given in the black color arrow in the lower part of the chart running from right to left. So why we are calling it a circular flow of income? If you focus on the blue color arrow in only, this completes a circle. So the factor services or factor inputs provided by the households, it is a real flow, okay, from it is flowing from households to the business on the upper part, and the producers on the other hand is supplying real goods and services which are produced by them to the households in the lower part of the chart. So this completes a circle, okay, and there is in the opposite direction there is a nominal flow. the firms are paying for use of various factor inputs in the form of different factor incomes, as I said, as shown in the black arrow on the upper part. And all those income received by the households is completely adjusted to buy various goods and services from the producers, which are basically represented in the lower part of the chart given by the black arrow running from right to left. This is again complete a circle. So there is a real flow in the clockwise direction given by the blue color arrow, and it is exactly matching, the amount is exactly matching by the black color circle, okay, which is basically representing the nominal flow. Nominal flow partly as factor payments on the upper part, and as payment for various goods and services in the lower part. So this simple chart here, which I'm terming as circular flow of income, is essentially narrating the interdependence, the transactions between the producers or business and the households, right? The producers are dependent on the household to use their factory services for undertaking production, and they are also dependent on the household to sell their goods and services. Similarly, the households are dependent on the business to basically sell their factory input and receive income in the form of wages, salaries, profit, interest income, rent, etc. And they use this income to buy various goods and services which are produced by the producers. So none of them, neither households nor the businesses, they can live in isolation. They are dependent on each other. Households are dependent on the producers basically to earn income, and they use this income to buy goods and services produced by the producers. And producers are dependent on the households because they have to use their factor inputs to produce goods and services, and then they can sell these goods and services which are producing to the households. So that shows the interdependence between the households and businesses, and later on I'll be explaining how this also establishes that total income in an economy, okay, is equal to total expenditure is equal to total value of goods and services. Now, obviously, why I'm telling this establishes the equality between aggregate income, aggregate spending, and aggregate output in an economy. Let us understand this way. So, total value of goods and services, which I'll say aggregate output, okay, will be equal to aggregate spending in the economy. As of now, I'm assuming aggregate spending is aggregate consumption spending. This was established in the lower part of the chart in the previous slide, right? The aggregate output that was flowing from producers to households in the blue color arrow from right to left in the previous chart, okay, that was exactly matching with aggregate spending of the household, which was given by the black color arrow running from the households to the business in the lower part of the chart earlier. Okay, now this also establishes the equality between aggregate spending and aggregate income, because we are assuming that the entire income received by the household by participating in the production process is adjusted to buy different goods and services. Okay, so this simple circular flow of income, the two sector model which I discussed with you, gives us very critical insight about interaction between the producers and households in an economy. And this establishes that total value of goods and services produced should be equal to total amount of income, should be equal to total amount of expenditure in an economy. In fact, this critical relation, critical equality between these three, aggregate income, aggregate spending, and aggregate output, is used by the economists and statisticians to compute GDP. GDP computation, which I'll be discussing in one of the sessions, following sessions. GDP can be computed either using income approach or expenditure approach or value added approach, production approach, right? So this basically uses this fact which is implied by the circular flow of income model, which we just discussed. Now let us relax some of the assumptions which we imposed in the two-sector model. We know that the entire income which owned by different stakeholders, okay, they don't enjoy the entire part of it. Why? There are different leakages. Part of the income earned by households in the form of wages and salaries is paid as tax to the government. Okay, so there is a leakage out of your total income which is going as tax to the government. Then households also receive from some income from the government, like the pensioners receive the pension. There are also transfer payments in the form of unemployment insurance. Okay, different types of subsidies. Okay, so the different stakeholders, like the households, out of their total income, partly they pay as tax to the government, and they also receive some transfer payments like unemployment insurance or pension. Okay, so if we deduct total amount of taxes paid from total amount of income earned by the household and add the transfer payments from the government, that is what is known as the disposable income, which is actually available to the households to spend on different things. So here government is a third sector which will be introducing in addition to the factor market and product market which we discussed earlier, which basically is critical to understand the flow of income from the farms or producers to the households. Then secondly, all the income which is received by different households is actually not adjusted for consumption spending. Every household saves a part of it. Okay, so there is another leakage which is in the form of savings out of the disposable income. Okay, and these savings assume the economy is having a well developed financial sector. So these savings is basically kept in the financial sector like a bank or insurance company or a equity in the equity market, in the bonds market. So households are diverting a part of their disposable income as savings which they are not using currently for consumption. Obviously, saving is basically future consumption. Basically, the saving amount of saving added to interest income or different types of return enhances income in the future, which can be used for buying various goods and services in the future. So basically, when we talk about consumption versus saving, it is basically a decision between current saving and futures, current consumption and future consumption. Okay, so again here there is a one form of leakage. Then so we have to introduce the financial sector where we'll basically divert a part of the disposable income in the form of savings. So the remaining is available for consumption for the households. Again, the entire amount of consumption spending doesn't go to the domestic producers, because out of our consumption spending, a part may be going to a foreign producer. Say if I'm using a shaving razor, okay, which is produced by a German company, so it is an imported product. So part of my consumption spending is not on an Indian product, rather a German product. If I'm purchasing a car manufactured by Toyota, and Toyota is a Japanese company, so then part of my consumption spending is not on goods and services produced by the Indians. Okay, part of that is spent as import. So there is another leakage. Okay, so if you want to capture these three forms of leakage, tax, savings, and imports, then we have to introduce another three sectors: government sector, financial sector, and of course the external sector. So this way I can expand my two sector model to a five sector model as given in the chart in front of you. But the essence of transaction between the firms and households remain the same. Only thing is some more details are added here. As you can see, you focus on the orange color where I put firms, orange color circle. Okay, so there from the firms, the uh, total amount of income generated is equal to total amount of production or GDP. So a part of the total income is basically diverted as taxes to the government, which is given in the purple color circle, and the remaining is going to the households. And there is some transfers added in the form of pension or in unemployment insurance, etc., which households receive from the government. So adding that, there is a total disposable income which is coming to the households given in the green circle. And now households, part of their disposable income they are putting in the financial institutions like banks, insurance companies, or financial market, etc., which is shown as private savings. Okay, and the remaining is consumed, but that out of that total consumption expenditure, partly again diverted to the rest of the world, which is the external sector in the form of imports, and the remaining is received by the domestic producers or farms. Okay, and then similarly you see part of the government spending is on various goods and services produced by the domestic farms. So you see a arrow from the purple color circle to the orange circle, that is farms. And from the financial institutions, the farms borrow to set up factory, the government borrow to undertake various economic activities, various finance various types of government expenditure. So you see a arrow from financial institutions moving to the government, moving to the firms, basically suggesting the savings of the households are used to give loan to the farms, loans to the government. So that way, total savings is equal to total borrowing in the system. And again, from the rest of the world also we are receiving some funds, which earlier in some session I told about foreign investment. These are basically savings of the foreigners which coming to our financial system. And again, those foreign savings, which we call foreign investment, is used by our firms and the government. And the rest of the from the rest of the world, the foreigners buy some of our products, which is our exports. So you see a arrow running from the rest of the world to our domestic firm, that is their spending on our goods and services, the goods and services produced by Indian producers. So again, this establishes the total income generated in the economy, okay, which is equal to GDP. So total product, value of total product, is equal to total income in the economy, and this income will be equal to total expenditure. Okay, if we add up the households expenditure, the expenditure of the foreigners, the expenditure of the government, okay, add together, this will be basically total spending of the economy. So if we try to focus on use of aggregate income earned by the households by participating in the production process, okay, by supplying various factor inputs, that total income is basically used principally in these four ways. Part of that is paid as tax. Part of that is used as consumption. Here by consumption I mean consumption spending on domestically produced goods and services. Part of that is saving that went to the financial sector as a leakage, and part of the aggregate income also used for imports. So these are basically consumption spending on foreign produced goods and services. So this basically adds up uh, different components on which total income is used, as explained in the previous chart. Then we can also summarize or sort of say aggregate different types of spending, which I'll call as aggregate spending. These are basically broadly under four heads. Okay, so here when I'm talking about aggregate spending, what I'm trying to focus on, I'm focusing on total spending by different stakeholders on goods and services produced domestically. So which is our GDP. Our GDP is total value of goods and services produced in India. Now, who are the different stakeholders who are buying these products? Principally, it is the households, and the household spending on domestically produced goods and services is captured in the form of consumption, which I'm denoting as C. And part of the spending is on investment goods, basically the capital goods produced by our farmer, different producers, and mainly this is basically the firms which undertake investment spending. And then government spends on various goods and services produced domestically, which is G. And then finally exports, which is foreigners spending on goods and services produced at home. So that way, by taking into account different stakeholders who buy goods and services produced in India, we have these four components of GDP, which are basically four uh, spending stakeholders, spenders, four types of spenders who are basically purchased various goods and services produced in India, which is GDP. Okay, so this was my attempt to discuss the first and most simple model in macroeconomics, that is the circular flow of income. And the main objective was to explain to you how using a simple model will basically capture the essence to a discussion in economics. So our objective was to try to establish that total income is equal to total value of goods and services and is equal to total expenditure in a macroeconomy, in an economy. Okay, so that we did using circular flow of income, first using a simple model, two sector model, and then extending to a five sector model, which tries to understand different interlinkages, behavior of different stakeholders. Okay, the simplified version of it. Okay, and using that we can explain how in an economy total income is equal to total value of goods and services is equal to total spending, right? So I'll be happy if this discussion was helpful for you, and I'm sure you will have many questions. Maybe a couple of things which might have told you may not be clear to you. In that case, please write to me, and I'll be trying to help you understand if you have any doubt. Thank you.